As a small business owner with a limited company, you often pay tax twice, once in the company and then once again personally. So let me show you how to bring that tax bill right down using my tax funnel method. As a business accountant, my team and I spend all day long helping small business owners on their journey. And the number one question we get asked by limited company owners, how do I pay myself in the most tax efficient way? So in this video, I'm going to take you through my tax funnel method, top to bottom, so you can see every legal way to get money out of your limited company. So we'll start with the free stuff, then we're going to move into the cheap stuff, and then we're going to finish with the more efficient situational strategies. And in the end, I'll show you worked examples so you can actually see the numbers when it all comes together. The higher up you are, the easier and the simpler the win, and the further you go down, the more specific and complex it gets. And it's worth noting that down the side here is an orange line. And just to say it once, we're not going anywhere near schemes that end up in HMRC's spotlight. If it sounds too good to be true, it probably is. And this orange line represents where it begins to be too good to be true. I'm going to cover a lot in this video and at speed. So as a reminder, do your own research. Everything I talk about here has strict criteria. So understand that if your circumstances match is really, really important. This is broad education and not advice. So starting with the free stuff then, these are the things that you often already pay for personally. I call these the you problem. You've likely already paid corporation tax and income tax on this money to then go out and buy the thing. So we want them to become a company problem, so you won't have paid either of those taxes on them. So naturally, shifting them into the company will instantly save tax. The first obvious example here is your mobile phone. If the company takes out a contract in its name and then supplies you the phone, there's a tax exemption that means you won't get taxed personally on it, regardless of how much you use it personally. And then often business owners also look to get some form of life insurance. Now, normally if the company pays for this, it counts as what's known as a taxable benefit. But using something called relevant life insurance can be completely tax-free. And then if we move down the list again in the free area of exemptions, you've got things like trivial benefits. Basically, this rule lets you buy gifts of under £50 for your team or even for yourself without triggering personal tax. Sadly though, your gifts are capped at £300 a tax year, and there are a few rules to be aware of, but check those out in another video where we break that all down. Now then, next up on the free list, we look at things like mileage in your personal car. If you're using your personal car for business journeys, you can claim back up to 45p a mile from your company. After the first 10,000 miles in a tax year, that 45p rate drops to 25p, but it's still a great claim because it gives you a tax deduction in the company. And then that money's owed back to you completely tax-free when you want to take it. And of course, it helps to offset the cost that you're already going to be paying for fuel in that personal car anyway. So for these business journeys, there's a tax deduction there. Now, usual tax caveat applies here that there are plenty of rules around what counts as a business journey that we've already covered in other videos. For example, driving or commuting to your office is not going to be a business journey. Think more about the journeys that you make to, say, a client's office or a customer's house to carry out a quote. Those kind of journeys are the more typical business journeys. Then, still in the free area, but moving down the list, we can have a think about things like food. Now, food's a tricky one because it's fraught with tax traps. In fact, I could do a whole other video on that, but let's look at a couple of specific ones. Firstly, there is an annual function exemption that allows your company to pay up to £150 per head for something like your Christmas do or your summer barbecue. And if the company pays for it, it can get a tax deduction and you won't get taxed personally if, of course, you meet the criteria. And you might be thinking, what about if I want both? And the company can actually pay for both of those events and you won't get taxed personally, but you've got to split that £150 limit across the two events. But be careful because it's not an allowance. Even if you go even £1 over, the whole amount's going to be taxable. So be mindful and stay under the limit. So next in the free list, on top of this, if you maintain an office, and this could be at your home, there are rules around supplying free or subsidised meals in your canteen. This can apply to directors working at a home office, but you've got to be careful. I doubt anyone's going to have an issue with you buying like a bowl of bananas, your coffee pods, but if you start sticking for your weekly shopping, you can imagine this is going to be an area that HMRC would challenge. While we're on the subject of your home, there's actually a fixed rate expense claim you can make that's meant to cover your home costs. So the time of recording the video is £6 a week, and that £6 meant to cover all of your things like heating, electric, and internet. Now, there is an alternative way to claim the actual costs, but it gets far more complicated, probably for another video. But for many owners, this baseline of this £6 is going to be quite common, and you'd enter it into your accounting software or records sort of once a year, and you'd earmark it as money owed back to you, something you might have heard to and been referred as adding to your director's loan account. Now, next up on the free list is pension contributions, specifically what's known as employers' pension contributions. So if you're looking to save for retirement and like the idea of a pension, this is a great way to save some corporation tax and get it into your hands. As your company employs you, the company can make contributions on your behalf and put that money into your pension pot. It's like in a normal job, you'd see that the employee contributes some and the employer pays some into the pot as well. But there's nothing stopping you as a limited company owner just having the employer pay in, which is often the best tax result anyway. Doing it this way means that the company gets a corporation tax deduction, and even even better, it doesn't count as personal income, so all of your allowances are still free to use elsewhere. Reminder again, there are limits in play here, but for most people, those limits are going to be pretty substantial. Now, of course, there are more niche claims we could do in the free area, but we're not going to go through them all here. There are things like welfare or counselling support, for example. And if you're thinking, look, Dan, this is a lot of information, I've created a document with a list of everything we discussed in this video and more, including a list of general tax deductions that you can use to check that you're not missing out on anything. And I've left you a link in the description below. So we've gone through a list of expenses and claims. So let's talk about the part that straddles the free and the cheap sections, and that's your pay. Now, for many of you, if this is your main source of income, it's likely that you're going to want to pay yourself at least a small amount of what's known as proper PAYE salary. This gives your company a corporation tax deduction on your pay, and if you pay yourself enough, at the time recording this video, at least around $6,500 a year for most people, you get what's known as a qualifying year, and that helps build up your state pension pot. And it also helps use some of your UK tax-free personal allowance, which I'll show you in a minute. These exact thresholds change over time, but often a small salary is going to be part of the plan. Now, the UK personal allowance at the time recording the video is just over $12,500 a year. So if this is your only income and your company paid this to you, you're not going to pay any income tax personally. So though in theory it could make the free part of the funnel, the reason it straddles the two is it's not always the case that it's entirely tax-free in the overall picture. So thanks to recent government changes, the company has to pay employers' national insurance contributions on your pay when it goes over £5,000 a year. So although you could pay yourself around £12,500 a year without any personal tax, the company itself is still going to have to pay some national insurance on your behalf if you pay at that level. You can get around this by using something called employment allowance, which we've done other videos on, but you need another person on the payroll and to be paid a certain amount of money to actually qualify. So sometimes it is free and sometimes it's just cheap. Either way though, when the company's your main source of income, you're likely to use some sort of proper salary. So next up on the funnel, we're fully into the cheap section now. And in this area, we're looking for things that aren't completely tax-free, but are certainly pretty cheap tax-wise. So the first stop is going to be something known as dividends. This is the profits coming out of the limited company. Now, these are still one of the most tax-efficient ways to take money out, despite the recent 2% tax rise. And this is partially because they're not actually subject to national insurance. So presuming your company had enough profits to pay the dividends, you'd want to maximize what's known as your basic rate band. So if we look at what I call our tax stack, at the time recording the video, you get this $12,500 personal allowance tax-free. We were talking about this bit. And then the next bit, up to around £50,000 a year, is what's known as the basic rate. Now, dividends in this area are only taxed at 10.75%. In theory, technically, there is also a small £500 allowance where the dividends are taxed at 0%, but hey, it's not that exciting. Now, because any unused allowances don't carry forward into the next year, it's important to use as much of this band as you can up in a single tax year. For many of you, you'll have this personal allowance tax-free bit already taken up by the salary we spoke about, or if you've got another job, something like that. So if you have the rest of this band free and the company has the profits, often you'll want to use as much of it as you can on dividend to pay right up to this 50k line. You might also want to use some of this band on taxable benefits. Your company can pay for most things as part of your own salary package, but if it does, you end up with this horrible benefit in kind tax. And that means that you and the company both pay tax. So normally you don't do this. However, sometimes it could be worth it if the savings outweigh the tax. So for example, if you're thinking about private medical insurance and you've seen that it's crazy cheap for the company to take it out versus what you'd pay personally, you might then decide it's better to have the company contract for it on your behalf. Now, when you do this, it causes a benefit in kind tax bill, but this is offset by the fact that this monthly payment is a lot lower. And the same can be said about other low tax benefits. So things like electric cars, despite the budget in 2025 announcing a new mileage charge on electric vehicles, are still pretty tax efficient for a limited company owner. So we're looking at the cheap areas of the tax funnel. Outside of a van, these are often the only vehicle that makes sense to have in a limited company from a tax point of view. And for vans and electric cars, there's currently some excellent upfront allowances that let you write off the full cost of the vehicle against your profits in the year that you buy them. As always, though, you need to meet specific criteria, and how you buy it is really, really important, but I'll leave that one for another video. Just note they're worth investigating. Now, the next one is odd, but it can save some tax on the fringe, and that's buying meals and entertaining business prospects. So are you taking a prospect out for a meal? Then the company can pay for that. You won't personally get taxed on the meal, even though the company doesn't actually get a tax deduction. But because it's not coming out of your income, you're saving income tax on having the company pay. So be sure to record all of those types of expenses, because the company can pay for them. It's just it can't get a tax deduction. Bit of an odd rule, I know, but it does save some tax. Now, next in the cheap area of the funnel would be paying some interest to yourself. So if the company owes you some money back, for example, so this director's loan account we're talking, let's say it has a balance and the company owes you some money, you can actually charge interest to the company. company. And for many owners, depending on your income, you can get normally £500 to £1,000 of interest tax-free. So this could be a great option, but there are two really annoying practical downsides when you do this. The first one is you have to do quarterly reporting to HMRC on what you've paid yourself in interest, and the company gets this return. And the fact that you have to deduct 20% tax each time you pay yourself, even if you don't owe it. It's just some outdated rules, but you get it back in your personal tax return if you do. It's just a massive faff to administer, but it is an option and worth mentioning. And for this reason, many owners actually tend to skip it, but it can work well. And it's these kind of areas in the cheap section that we're often looking at. Now we've reached the bottom of the funnel, and that's the efficient section. Now, what works here really depends on your individual situations. So whilst not every tip in this section is going to apply to you, I'm hoping it's going to give you some inspiration and just some things to look into and research. So firstly, if you've got a significant other that you share finances with in the household, giving them shares can sometimes bring another set of tax allowances in. So stereotypically, this is going to be your spouse. Now, being able to pay dividends to another person can really help reduce your overall tax bill because you could use their allowances as well. If you want to do this, or perhaps you already have, you should consider looking into something known as an alphabet share structure. And that can mean that you can vary the amount of dividends that are paid to individuals. And this can be really effective if the shareholders have different tax situations. Sometimes you might not want to pay a dividend to the other person. And the reason they're called alphabet shares is because often you call them ordinary A and ordinary B and ordinary C, for example. So in this particular example, we've got a husband and wife that own 50% of the shares each. One of them holds A shares and one of them holds B shares. So if we just wanted to pay a £500 dividend to the wife because she has the allowance free, maybe the husband doesn't, we don't want to have to pay £1,000 out, so pay 500 here, 500 there, because the husband's going to pay tax, he might not want the money. But having this structure set up properly can allow the £500 to land just here, because you just pay the dividend on the B shares. And of course, we're using £500 as an example here, but it could be bigger money. Now, I have to say this option is fraught, and I mean fraught with technical difficulties, tax traps, but hopefully you get the general idea of what's possible. So do check out the detail of this one if you're thinking of doing it yourself. Get the right advice and make sure it's technically set up correctly. Beyond your spouse, you could also consider involving the wider family. Like, do you have any teenagers that might want to do some work for the company, for example? So whilst it's possible from age 14, I actually find 16 onwards tends to be the best for various reasons. If they actually do work for the business, paying them through payroll is often far more efficient than giving them pocket money from already taxed income. Because even teenagers have this 12.5 grand-ish personal allowance if they've got no other income. So paying them some salary for the work they do is unlikely to cause them a tax bill at this age. And the company can even get a tax deduction on their wages, gives you even more tax saving. Again, it's important they're genuinely employed, they're paid a reasonable wage, they're actually doing work for the business, etc., etc. But when done correctly, it can really work. I find this is especially useful if you're already constantly reaching into your own pocket to cover their expenses. I've got teenagers, because as before, you've already paid tax on that money that you're giving to them. In this case, your kids are very much a you problem, and we don't want them to be. So having them earn their own money and be paid salary switches it into a favourable tax situation, and it's now a company problem. So again, loads of complexity here for you to research and look into before you do this. Next up, we touched on directors' loans before, but that's when the company owed you money. But it's possible to do the opposite and have the company lend you some money. You can actually borrow up to £10,000 tax-free. The big challenge with this one, though, is that if the loan's outstanding 9 months after your company year end, the company then has to pay this brutal tax charge. But there are instances where, like, loaning an amount of money to you as a director, particularly near the end of a tax year, can actually save tax. Because what you can do is you can actually repay the loan by declaring yourself some profits, some dividends in the next tax year when your allowance is reset. It's a tricky area with timings and repayments, but used in the right moment can actually be very effective for saving tax. If I've lost you, it's because we are reaching the bottom of this funnel, and it does get pretty complex around here. So let's have a look at what it all looks like in practice. By stacking on the free items and using the small salary, taking the basic rate dividends, using your pensions properly, you can often extract around £120,000 worth of value at a personal tax rate of about 4% and a bit in this example. Pretty good, right? Why? Because you turned a whole list of personal expenses, phone, mileage, insurance, kids, all that lot, into company expenses. You stopped paying tax on the money before you spent it. So if you look at the items on the list, much of it was a you problem before, now it's a company problem, which is why I like to look at it this way. So for example, if you already had a phone, maintained a car, bought your coffee pods, paid for life insurance, if you arrange it like this, it can really save some tax. Now, the keen-eyed would have spotted, of course, the company has paid some corporation tax, which I haven't factored into this example, but you get the idea. It's super efficient. Now, is this every method of taking money out of your limited company? No, for sure there's going to be some other ones, but we'd be here forever. But these are the main, biggest, safest legal ways to take money out of your limited company. And not every method is going to apply to you, so do your own research. If you want to learn more about the specifics of some of the things I've spoken about in these videos, check out the videos on the screen, and I'll see you in the next one.